All right. Hi, I'm Stacy Sanchez. I'm a senior community loan officer with CDC Small Business Finance. CDC is a private nonprofit, and we are a certified development corporation authorized to make SBA 504 loans, which is a product that's used for the purchase of like real estate or a building. And we're also a community advantage lender, which allows us to make SBA loans up to $250,000, and we do that in California, Arizona, and Nevada. And we're also an SBA micro lender, which allows us to make loans up to $50,000 through most of the counties in California. We have had a great year. We are actually looking to fund close to 75 loans this year, which is a little over 30 more than we did last year. So we're seeing an improvement in the economy, and quite a few of the loans that we have done this year, and myself in particular, have been business acquisition loans. And I think that this is a little bit telling about how the economy is getting a little bit better. People have been holding off to sell their business, and maybe now they're ready. I've seen the reasons for people selling have been retirement and or new jobs. Maybe one of the spouse in the household has gotten a new job, which is going to take them out of state, and then they have a need to sell the business. So we've done quite a few business acquisition loans. I've got roughly 6 that I have done this year.
What should the business look like they're looking to purchase?
You know, people call and they want me to pre-qualify them. They want me to prepare something that they can take back to the seller to say, hey, I'm qualified to buy your business. But really, when in SBA financing in particular, the business acquisition decision is based a lot on the business that they're buying. And so what we want to see is a profitable business. We want to see 3-year seller tax returns. And using those seller tax returns, we can evaluate the value of the business. Many people think that the value is going to be based on how much sales that the business does. But as a lender, we typically are going to value the business based on the net profit. So this can be a problem in small business financing, especially when we're talking about a sale of $100,000 or $200,000. Because the small business owner may have a tax strategy that lets them expense a lot of maybe personal expenses and a lot of other miscellaneous business expenses that reduce the net profit so they don't have to pay as much in taxes. But when I'm doing my valuation, I'm looking at the net profit of the business, and then I'm going to add back non-cash expenses. Depreciation, interest on loans that the seller has been paying on that the buyer won't pay on when they own the business, and maybe non-reoccurring expenses. Things like the seller had to put a roof on last year, so the expenses that they put into that, we'd add that back in because that's not going to happen again for 20 years, right? But we won't add back all of the expenses that the seller has put in there to reduce his taxable income. So that can have an impact on the valuation of the business.
Now, what happens when you have some business owners don't want to show their financials to just every stray person saying, I'm interested in buying your business? What happens in those circumstances?
It's not uncommon for the seller not to want to give the buyer access to their tax returns. They want the buyer to somehow pick a number and make an offer based on, I don't know, how they've been watching the business maybe for a few days. But they want an offer on the table, or they want an escrow opened before they're willing to give the buyer the tax returns. I'm not sure how they're supposed to come up with a purchase price, but that's so common. If the seller's working with a broker, oftentimes they'll give them maybe just the financial statements or a summary of the financial statements, which I would take if there was nothing else. It would tell me at least that we're in the ballpark. But the suggestion I make is have the seller send the tax returns directly to the lender, and then the lender can complete the pre-qualification and let the buyer know whether or not it values, do they qualify, get back to the seller, get the formal offer in, and then get the actual tax returns so that we can complete the analysis of the business that they want to buy. That's one way. I think that's worked for me. Sellers feel a little bit more comfortable. They can, verify that I am in fact a lender. They can contact me and send it to me, and then I'm not allowed to share them with the buyer until we've moved forward in the project. And the seller has to give me permission in order for that to happen.
Okay, so that would make the seller much more comfortable, and it would make the buyer more comfortable too, saying now at least someone is looking at these numbers and I'm not making a bid in the blind.
Yeah, you're absolutely right. That's sort of just an extra plus. They get the benefit of my software valuation that tells them what I think the business is worth. In SBA financing, if the loan amount is under $250,000, the lender can do an internal valuation of the business, and we have a software program that we use. If it's a larger acquisition, then SBA is going to typically require that the lender get an outside valuation of the business. But that's usually after you've been approved, and then it makes more sense to spend that kind of money on an appraisal, for example.